Today, we're delving into a topic that's been causing quite a buzz in the world of finance: AT&T and Verizon stocks. These telecom giants have weathered some tough times recently thanks to rising interest rates and sector-specific challenges. But here's the exciting part: they both offer enticing high yields and seem to be flying under the radar in terms of valuation. Over the past 2 years, the telecommunications industry, often represented in the S&P Telecom ETF, ticker symbol XTL, has faced significant challenges. Companies in this sector have experienced a series of setbacks, primarily stemming from consistently low returns on invested capital, substantial capital expenditure requirements, rapidly increasing interest rates, apprehensions about the potential entry of Amazon into the market, and a recent investigation initiated by the Justice Department and EPA concerning telecom companies and their use of lead cables. In this video, we'll do a deep dive into AT&T and Verizon, comparing them side by side following their Q3 results. By the end, you'll have a clear understanding of which of these telecom giants might just be the better buy for you today. So grab your coffee, sit back, and let's get started on this investment journey. Starting with the earnings of AT&T in the third quarter, AT&T exhibited strength in free cash flow generation, leading to an upward revision of their 2023 guidance to approximately $16.5 billion. Despite fluctuations in wireless customer trends, they improved sequentially, hinting at a favorable competitive landscape in the U.S. wireless industry. However, there was a decline in net postpaid phone customers year-over-year. Nevertheless, there were positive signs such as a 3.7% growth in revenue per customer in wireless service revenue. AT&T generated $5.2 billion in consolidated free cash flow during the quarter, reducing their net debt by over $3 billion to approximately $129 billion. But top-line growth remained modest and adjusted earnings per share (EPS) declined. Management gave very encouraging guidance for growing free cash flow in 2024 as wireless network investment stabilizes. However, investors hoping that this will translate into higher capital returns to shareholders will likely have to wait, as management plans to utilize the extra free cash flow to retire upcoming debt maturities rather than to buy back stock or grow the dividend. Switching gears to Verizon's Q3 performance, which was impressive with a 9.27% stock increase following the results release. Notably, they achieved 100,000 net year-over-year postpaid phone customer growth and a 2.2% increase in average revenue per consumer postpaid wireless accounts. Their year-to-date free cash flow reached $14.6 billion and they reduced debt to $143 billion. However, revenue declined by 2.6% year-over-year and adjusted EBITDA showed only a slight increase. Despite these challenges, Verizon's performance in net customer growth and strong free cash flow reflects their resilience in a challenging telecom environment. Now for the part that all dividend investors are eager to know: the dividend analysis. Both T and VZ are expected to have limited dividend growth prospects in the coming years as both remain focused on investing in their capital-intensive businesses and deleveraging their balance sheets in a higher cost of capital environment. Both businesses have similar leverage ratios at the moment and remain committed to strengthening their balance sheets in the coming quarters. In terms of payout ratio, Verizon's expected payout ratio in 2023 is 55%. Whereas AT&T's is 45.5%, seemingly indicating that T's dividend is on firmer footing. However, Verizon's dividend track record is much more impressive than T's, as it slashed its dividend in 2022, whereas VZ has grown its dividend every year for 17 years in a row. Moreover, when the management team spoke about the future outlook for their respective dividends on their Q3 earnings calls, AT&T sounded like it was trying to assure investors that its current dividend payout was sustainable, whereas VZ's management continued to speak about future dividend growth. Here's what T's CEO had to say about their dividends. "We remain committed to our dividend payout level and expect its credit quality to consistently improve. In fact, we've already generated more than enough cash to meet our annualized dividend even before the fourth quarter, which is generally our highest cash generation quarter." Here's what Verizon's CEO said on their earnings call. During the third quarter, we paid down $2.6 billion in debt and increased our dividend for the 17th consecutive year, a current industry record that we take pride in. Our dividend coverage is very healthy. Year-to-date, our free cash flow dividend payout ratio is approximately 56%, a significant improvement from a year ago. Number 1 in the capital allocation is to invest in our business. Number 2 is to continue to put our board in a position so they can increase our dividend. We are on 17 years of consecutive increases. When we look at the price-to-earnings (PE) ratios, which help us understand how much we're paying for each dollar a company earns, T looks like a better deal. T has a forward PE ratio of approximately 6x, which means you pay $6 for each $1 of earnings, while VZ has a higher PE ratio of 7.12x, meaning you pay a bit more for VZ's earnings. Now, if we consider another way to assess their value, we can take a look at their EV to EBITDA. That stands for enterprise value to earnings before interest, taxes, depreciation, and amortization. It's a financial metric used to evaluate the overall value of a company in relation to its earnings while taking into account its debt and other financial obligations. In this case, T also seems a bit cheaper. T's EV to EBITDA is lower than that of VZ. This tells us that T is a better deal based on this measure. However, there's one more thing to consider. VZ offers investors a higher dividend yield in the near term. VZ's dividend yield is 7.95%, while T's is 7.49%. This means VZ pays more to its investors in dividends compared to the price of its stock. In the end, it's a bit of a trade-off. T appears to be a better value in terms of traditional valuation measures, but VZ offers a more attractive dividend yield to investors in the near future. It's all about what you're looking for in your investment. So which one should you consider for your investment portfolio? Well, it depends on your investment goals. If you're a dividend investor, Verizon seems to be the way to go given their track record and management's commitment to dividend growth. On the other hand, T might be more appealing to value-focused investors. But remember folks, these are just some key points to consider. As always, do your due diligence, keep an eye on the market, and make investment decisions that align with your financial goals. And that's a wrap for today's analysis. If you found this video helpful, don't forget to hit that like button and subscribe to the channel. Your support is always appreciated.